Hi children, today we are going to see chapter 3 Goodwill. First we will see the introduction, then we will go to the features or characteristics, then we will move on to the methods on calculation of goodwill. First we will see the introduction of goodwill. Goodwill is an intangible asset which places an enterprise at an advantageous position. It is nothing but goodwill is a good name which the company has earned among the satisfied companies or customers in our business. Next, characteristics or features of goodwill. It is an intangible asset. Of course, the good name which we have earned with the satisfied customers, that we couldn't able to see it but we can able to feel it. That means it does not have any physical evidence. It helps in higher profits. Of course, when the customers are satisfied with the service what we are rendering to them, then it will automatically lead into earning of higher profits to our business. Next, the existence of goodwill we can able to feel through various forms like patents, trademark, and we can able to say brand, favorable contracts, market reputation, etc. Next, in the context of partnership, it is a value of share of sacrificed by the sacrificing partner. Next, we are going to see the methods of valuation of goodwill. There are three important methods of valuation of goodwill. One is average profit method, another one is super profit method, and capitalization method. First, what we are going to see is average profit method. Under the average profit method, we have two different methods. One is simple average profit method, that is considered to be very easiest method of calculation of goodwill, and another one is weighted average profit method. First, we will see the introduction of simple average profit method. How we are going to calculate the simple average profit method? First, we have to calculate the normal business profit. That means what the business has earned a profit in the present year by deducting the abnormal gain. That means we have to exclude the abnormal gain and we have to add what are the losses. That means abnormal losses what we have incurred in the present year. That means average profit equal to total normal profit divided by number of years. Then the goodwill will be calculated with the average profit multiplied by number of years of purchase of goodwill. Now we will see what is abnormal loss and abnormal gain. First we will see what is abnormal loss. What all the losses we are going to add it. First we can able to say loss by fire or loss by theft. Whatever happened in our business in a particular year. Then the loss on sale of fixed asset. Any fixed asset what we are selling in the present financial year. Next, overvaluation of opening stock or undervaluation of closing stock. Any undervaluation of closing stock will have an effect in our financial statement and also in our goodwill. The same thing will have an effect in the opening stock, that means overvaluation of opening stock. Next, non-recurring expenses. Non-recurring expenses is nothing but it will not happen every year but it will occasionally happen. Then the next thing, capital expenditure charged as revenue expenditure. That also we have to add it. That is also considered to be the abnormal loss. Next, we are going to see the abnormal gain. That means these are all the things we are going to deduct it when you are going to calculate the average profit. First, we will see the gain on sale of fixed assets. Any gain what you have earned by selling the fixed assets. Next, overvaluation of closing stock and undervaluation of opening stock. That will have an effect in the next financial year. So, we have to deduct it. Next, non-recurring income. That means every year it will not happen but sometime it will happen. Next, income from non-trade investment. Apart from trade investment, we have some non-trade investment. That also I have explained. Just wait. Next, partners remuneration if it is not deducted. That means any remuneration of the partners as we mentioned in the partnership deed. If that is not anything deducted, then that has to be deducted. Next, any further expenses like insurance premium. Any insurance premium if you are going to earn in that particular year, then that has to be deducted because it is considered to be an abnormal gain. Now I think you are very much clear about the abnormal gain and loss, so that we can go to the method directly, like average profit method. We will weight average profit equal to, after deducting the abnormal gain and after adding the abnormal loss, Thereby we will getting an average profit. That average profit has to be divided with the number of years of profit which we have seen. Then the average profit which we have calculated, that has to be multiplied with the number of years of purchase. Now we are going to the next method, which is nothing but weighted average profit method. It is a method under which weight is assigned to each year. That means first year will be given a weight of 1, second year will be given a weight of 2, third year 3, fourth year 4. Like that every year will be given a weight. Even that weight will be calculated, that means added together along with the weighted profit. That is nothing but we have to multiply that weight with the profit of that particular year, so that we will be getting a weighted profit. That weighted profit has to be totaled, that has to be divided with the total of weights. Next, with that weighted average, the goodwill will be calculated with the multiplication of number of years of purchase. Next, we are going to see the super profit method. First, we will see what is super profit. Super profit is nothing but an extra profit. That means we will be having some mindset that this much are profit when we invest in some business. But apart from that thing, for example, if you are going to earn 10,000 as a profit in your business, but fortunately or unfortunately, if you are earning more than 10,000, like 20,000, 30,000, then that extra money or return, that is considered to be a super profit method. Then in that method, we will be calculating the capital employed. Capital employed of the business will be calculated in different methods. First, the capital employed will be calculated from liability side approach and also from the asset side approach. When you calculate from the liability side approach, the capital employed will be calculated as of capital plus reserves, what and all we are having it, and we have to deduct the goodwill, if anything, which is already existing in the book, and minus fictitious asset and non-trade investment. I will explain what is trade investments, non-trade investment and fictitious asset. If you are going to calculate the weighted average method, the super profit method, then it will also be calculated from the asset side approach, which is of capital employed is equal to all assets except goodwill, non-trade investment and fictitious assets minus other liabilities, whatever we have in our statement. What is trade investment? Trade investments are nothing but the investments are made in another enterprise or another business to expand our own business. The investment will be made again in another enterprise or a business to expand the present business. Thereby it is considered to be the trade investment. Next, what we are going to see is non-trade investment. The investment will be made in form of FD. For example, fixed deposit. I am just saying an example, but the investment will not be made in any other business enterprise to expansion of business. Next, fictitious asset. Fictitious asset are those assets not asset at all. However, they are shown as an asset as in the financial statement for time being. For example, we can say the business promotion expenses, that is actually considered to be the expenses or losses which has to be written off in the present year. These are all considered to be the examples of fictitious asset. Next, what we are going to see is how we are going to calculate the goodwill under this method. First, we have to calculate the average capital employed. Average capital employed will be calculated with the opening capital employed plus the closing capital employed, that has to be divided by 2. The opening and the closing has to be calculated, or that has to be deducted by 2. The capital employed can also be calculated with the capital plus reserves minus fictitious assets if we have any, as I said, any business expenses or promotion expenses, minus non-trade investments minus goodwill. Or we can able to calculate with all assets except goodwill and non-trade investment, which is not considered to be the investment in trade, and fictitious asset like business promotion expenses minus outside liabilities. Then the next step will be we have to calculate the adjusted business profit excluding the gains and including the abnormal losses. Step 3. Now we know what is a normal profit that profit has to be calculated with the average capital employed, whatever we have found out in step 2, that has to be multiplied with the normal rate of return that will be given in the sum itself, that has to be multiplied with the capital employed, what we have found it earlier. Next, now we are going to calculate the super profit. The super profit will be calculated with the actual average profit that has to be subtracted with the normal profit. The actual average profit, which is nothing but which we will be getting in the total normal profit divided by number of years, that profit has to be subtracted with the normal profit which we have calculated with the normal rate of return. Next, the goodwill will be calculated with the amount of super profit whatever we have calculated, that has to be multiplied with the number of years of purchase. Now we are going to see the capitalization method. Under the capitalization method, we have two methods. One is capitalization of average profit method and capitalization of super profit method. Now we are going to see the capitalization of average profit method. Under this method, the goodwill will be calculated by deducting the capital employed of the business and the normal rate of return. First, we are going to calculate the capitalization value of the firm. To calculate that, we have to calculate the average normal profit earned by the business in that particular year, that we know from the first method, and from that we will be deducting the normal rate of return which will be given in the sum itself, that has to be divided, that is considered to be the second sum. Then this value will be kept aside, this total capitalized value of the firm which we have calculated from these two steps, that will be kept aside. And we will go to the third step. Then here we will be determining the value of a net asset. The net asset of the firm will be calculated by excluding the goodwill and the non-current investment and fictitious asset. Sometimes we will have some outside liabilities, that also has to be deducted. Now we have the value of total or net asset of a business. Now we have the value of capitalization value of the business. Then these both things has to be deducted to find out the goodwill. Next method, capitalization of super profit method. Now in that method, in this method, we are going to calculate the goodwill in the super profit method. First, we will calculate the capital employed. The capital employed will be calculated with the net assets of the goodwill. We all know the net assets which we are going to calculate, which will exclude the goodwill, non-current investment and fictitious assets. Apart from that, we will also subtract the outside liabilities which we have anything in this present financial year. Next, then the normal profit has to be calculated with the multiplied by the normal return. In the previous average profit method, capitalization of average profit method, we will be dividing it the normal rate of return. In this method, super profit method, we will multiply it. Whatever the amount we are calculating as capital employed, that has to be multiplied with the normal rate of return which will be given in the sum. Next, then the average goodwill, that means super profit, will be calculated with the average profit minus normal profit. Average profit whatever we have calculated already and the normal profit. Next, the goodwill will be calculated as super profit multiplied by 100 divided by normal rate of return. Next videos we will see how we are going to calculate it. Thank you.